Why pay off your mortgage sooner than necessary? In this episode, I'm going to address the question, should I pay off my house or invest? And as you listen to my response, you're going to gain insights into some opportunities that maybe you didn't know existed before. And I'm going to share with you sort of a glimpse into a new book I'm writing, How Money Really Works. I'm Doug Andrew. I've been blessed to have authored 11 books thus far in my life, and I've had many bestsellers. One was a New York Times Wall Street Journal #1 bestseller in 2007. But a lot of my books focus on this exact topic, and people have asked me for years, hey, I've got this extra money. Should I pay off my house, hurry and pay off my house, or should I invest? And so I began to then ask them how money really works. And it's amazing how many people don't really understand what you can do with money. Now, there's 4 basic things you can do with money. You can spend it, lend it, own with it, or give it away. And so I sort of double dip. I actually own a real estate, my house and other real estate, and I loan on the same assets, and I earn incredible rates of return because I'm able to sort of multiply my talents as I teach my children and grandchildren, even at our annual Grandpa's Camp, and that comes from the New Testament, Matthew 25, multiplying your talents. And so I think instead of just paying off your house and then starting to invest, most people don't understand how money really works. So I'm going to share with you, first of all, why the rate of return on real estate equity is always zero, nada. And then once you understand that, maybe you'll understand better what I'm going to share with you as far as keeping that money investing over here at a higher compounding rate of return, hopefully tax-free like I do, versus the simple interest declining balance mortgage that you have on a house. And when you understand that arbitrage or that difference, you are becoming your own banker. So a lot of times I ask people, if I took a $100 bill and buried it in a tin can in my backyard, they visualize that. Is that $100 bill buried in my backyard liquid? And they go, well, yeah, as long as you can remember where you buried it, right? Yeah. Is it safe? Well, maybe as long as my wife doesn't know where I buried it, maybe, okay? Is it earning a rate of return? And they go, no. In fact, it's probably doing what? Depreciating in value. So what's the difference between the $100 bill buried in my backyard in a tin can and the hundreds and thousands of dollars that we tie up in the bricks, mortar, wooden foundation of our houses? I would submit that the $100 bill in the backyard is more liquid and safe than the equity in your house because the rate of return on real estate equity is always zero. So to illustrate why real estate equity has a zero rate of return, I'm going to use these 2 goblets here. Let's say I'm filling out my balance sheet, my statement of net worth. If I'm going to do that for the bank, I list my assets and my liabilities. So if I have a $100,000 house, let's say, and I have $100,000 of liquid cash, what do I have in total assets? $200,000. A house worth $100,000 and $100,000 of cash, and I've not put the first dollar of this over into the house, okay? Now, it may be true I have $200,000 of assets minus a $100,000 mortgage liability for a net worth of $100,000 day 1. But day 2 forward, it's much greater if you keep them separated. Because what happens if you pay a 20% down payment, okay? Most people, they pay a down payment. I've never paid a down payment for any piece of property I've acquired. I've satisfied down payments, but not with my money because of this very concept. Some people, they have a bunch of equity from their former house, and what do? They put it into the new house in a bigger down payment, and they think that lower mortgages mean lower cost because nobody ever taught them about opportunity cost, which I'm going to talk about next. Sometimes people have the cash, and so they just pay cash for the property, or they pay it off. Now, what did I just do by paying it off or paying cash for the property? I just took one $100,000 asset, the house, and another $100,000 asset, my cash, and I just combined them together into one $100,000 asset. I just cut them in half. Did you see that? Now, what happens if I separate 20%? 80%, which is what I do, or 100%. Whenever I can qualify, I separate 100% of my real estate equity. What did I just do to my assets? I just doubled my assets. Now, let's say this house appreciates this year 5%. What is this worth at the end of the year? $105,000. Oh, let's increase the rate of return by paying it off. So we hurry and we pay it off and we put all of our money over there, and now it goes up in value 5%. Now what is it worth? 105. How come the same answer? Because the rate of return on real estate equity is always the same. Zero. Zip, nada. This has nothing to do with how much I owe on it. It could be mortgaged to the hilt or full of cash. It doesn't matter if it's empty and mortgaged to the hilt. This is going to go up or down in value regardless. The only way you increase the rate of return on equity is by separating it. Let's say this earns 10% this year. I've been earning 10% for 25 years, average. What is this worth? 110 at the end of the first year. Wait a minute. You mean I made 10,000 here and 5,000 here? Yep. For a total of 15,000. How much better is 15,000 than 5? Okay, 3 times as much. People say, but there's a mortgage there. Is that good or bad? If I borrowed at 6% interest on a mortgage and in a 33% tax bracket, it's not costing me 6%, it only costs me 4%. I'm saving that money. Instead of making 15, you take 15,000 minus 4,000 on the mortgage, and I made a net of 11. How much better is 11% net than 5% with the paid off house? This is huge. See, what would you rather have, 1 horse working for you or 2 horses working for you? When I have my equity separated, I give it the ability to earn a rate of return, and I usually earn at least double what the cost of the mortgage is. This is a simple interest declining balance tax deductible. This is a compounding balance tax free. And if you do this over time, you'll end up with an extra $1 million, $2 million, $4 million by not sending the extra principal payments to the mortgage company. Do you understand that? Do you see it? So what happens if this house goes down in value? People say, well, yeah, now you owe more than your house is worth. Do I care? If I have this house go down in value, did I lose? No, I have my money over here. So regardless of what you show me, I would rather have my equity separated, because the house will go up or down regardless of how much equity is in there. And I want to be my own banker and make double what the cost of the mortgage is or more. So coming back full circle, having seen that illustration, when people say, should I pay off my house or invest? Well, I wouldn't be in a hurry to pay off the house, but it's a function of what is the cost of using OPM, other people's money. But this is how money really works. Banks, when they borrow our money, when you put it in the bank in a savings account or a credit union, they're paying us interest, but it's very nominal, maybe 1%. So let's say they pay us 1% interest. Every million that they borrow from us who deposit money in the bank, they pay out $10,000 a year. But they turn around and they loan that million out at 3, 4, 5, 6%. Now, if they make 5%, that's 50 grand. So the bank is making 50,000 at a cost of 10,000. Let me just word it this way. If you were a business owner and you had an employee, would you hire an employee and pay that you could pay them 10,000 to do this and they make you an extra 50? That's called a 500% return on employment cost. If you bought a widget machine for 10 grand that made you an extra 50 grand, how many widget machines would you buy? This is not just a little bit more. Sometimes people say, well, if you borrow on a mortgage at 4.5%, if it's tax deductible, it doesn't cost you 4.5%. You write off on $1 million mortgage, $45,000 a year in interest at 4.5%. But if you're in a 33% tax bracket, it's not costing you 45 because you get 15,000 of that back because you wrote off 45,000. The net cost to you out of your pocket was only 30,000. So a 4.5% deductible mortgage is only really 3. I've been making 9%, 10% for years. How much more is 9 than 3? Don't say 6. It's 300% more. Would you hire an employee for 30 grand that made you an extra 90 grand? I'll do that all day long. But it compounds and grows. Recently, I borrowed money at 3% tax deductible. It's a net cost of 2. And I have made 10.07. How much more is 10 than 2? 500% more. It's 5 times. Banks have been making 500%. I've been making 500%. You wouldn't believe how many Americans don't understand what I just said. So when it gets down to the nitty gritty, you're going to incur one of 2 different costs. If you leave your equity in your house and you hurry and pay it off, you have given up the opportunity to earn a rate of return on those dollars, because you now know that the rate of return on real estate equity is 0. It's going to do whatever it does, regardless of whether it's mortgaged to the hilt or free and clear. So that's called an opportunity cost. You've given up the opportunity to earn, let's say, 6, 7, 8% or more, like I do. So, but if you borrow it out, there's a cost. That's called an employment cost, because I'm going to borrow it out and employ that money. I'm going to pay an employee a certain amount of money because they're going to make me more than they cost me. That's called an employment cost. So if you have to incur one cost or the other, but one of those costs is deductible, one is not, what would you rather incur? I'd rather incur deductible employment costs, not non-deductible opportunity costs. And like I said, if I borrow at 4.5%, it's a net cost of 3, and I earn just 6. How much more is 6 than 3? It's double. I'll pay 30 grand to make an extra 60 grand all day long. Let me give you an actual story to tie this all together of what happened to me back in 2008. So in December of 2007, I could sort of see the writing on the wall. And of course, what happened in 2008, the mortgage meltdown, and properties dropped in value, the stock market, people lost 40% of the value of their IRAs and 401ks. I could see it coming. Back then, in 2007, my house was worth about 1.5 million, okay? Now, I went ahead and mortgaged and separated that equity. And sure enough, a year later, in December of 2008, my house was only valued at 1.1 million. It went down $400,000. Now, I had critics that went, "Oh, neener, Mr. Andrew, you're underwater. You owe more than your house is worth. It's only worth 1.1 million. You owe 1.5 million, because I had mortgaged it on a first mortgage up to 80% and a second and third mortgage up to 100%. Wait a minute. I said, who's in control here? I am. I never missed a mortgage payment. I had people all over the place that had been paying extra principal payments, and they lost their homes in foreclosure because they had no liquidity. I had all my liquidity. But guess what happened? For 10 years, until my house came back up to $1.5 million, on that $400,000, let's say, I was paying interest at 6%, tax deductible, and net cost of 4. I was earning 8%, even 10% some years, compounding tax-free. Do you know what? I was able to, on that $400,000, the very first year, I'm paying $16,000, I'm making $32,000, okay? And so that's double. But over that time period of 10 years, the actual excess money I made, because I had my equity working for me and I didn't pay off the house I invested, was $864,000 extra dollars I made by not putting the money in the house and waiting for it to come back to the value it had 10 years earlier. Does that make sense? If you want to know more, I would implore you to read some of my books, Misfortune 101. But let me show you my most recent bestseller, and I'll pay for the book. You pay $5.95 towards the shipping and handling, and I'll send it out to you free. So this is my 11th book. It's actually 2 books in one. Here's one. Here's one. This book is comprised of about 200 pages, 14 chapters with all kinds of charts and graphs explaining concepts like this. But if you learn by stories, you flip it over. This is about 100 pages, 12 chapters with 62 chicken soup for the financial soul stories. And there's actual examples in here of clients who have done what I just talked about, and they accumulated hundreds of thousands of extra dollars by not sit there and paying the house off before they started to invest. So again, if you'd like to claim your free copy, go to laserfund.com, laserfund.com. You pay $5.95 towards the shipping and handling. I'll cover the rest, and I'll pay for the book.